This is a time of great suffering and difficulty, and it's come on us so quickly and with such force that you really can't put into words the pain people are feeling and the uncertainty they're realizing. And it's going to take a while for us to get back, but I would just say this: in the long run, and even in the medium run, you wouldn't want to bet against the American economy.
So the Fed chairman says more can be done, but does the Federal Reserve really have more ammunition left to limit the economic damage of this crisis? Or are we already past the tipping point for a new Great Depression? It's that time again, time to tune out the hype and focus on the facts. Yes, facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
Joining me right now is Sound Income Strategies founder and CEO David Scranton.
They've created a new type of inflation. And although markets have always been an emotional place, they seem to be even more of an emotional place these days.
Jeffrey Small, market watcher, is with me.
Stock market dynamic is getting ready to significantly change.
So let's bring in our co-host, Jeff Small, president of Arbour Financial Services, and also the brand ambassador for the Retirement Income Store. Yes, the country is carefully reopening after 2 months of a lockdown, but no one is breathing a sign of relief quite yet. Uncertainty and fear are still the most dominant emotions for many Americans, and about 1,000 questions have yet to be answered. Recently, Federal Reserve Chairman Jerome Powell attempted to answer some of these on 60 Minutes. On today's show, we'll talk about some of his answers and take a closer look at the Fed's response to the coronavirus crisis thus far. How much will it help? Can the Fed really do more? Will we see negative interest rates? And finally, has the Fed's reckless overuse of artificial stimulus actually made the crisis potentially worse than otherwise would have been? We'll examine these questions and more with the help of today's special guest, author and newsletter editor Harry Dent. Also joining me as usual is my co-host Jeff Small. Before we bring in Jeff, let's look at some key steps the Fed has taken so far and how they're meant to help. To its credit, the Fed acted quickly to try and cushion the economic blow of the pandemic, first by lowering its benchmark interest rate to 0. The move is aimed at reducing borrowing costs for mortgages, cars, home equity, and other loans. It also looks to keep the banking system flowing. However, with the pandemic creating an unprecedented economic stoppage, much more Fed intervention was needed. So here are some of the other important actions the Fed's taken in response to the crisis. First, securities purchases. That's right, more quantitative easing, a tool that the Fed and other central banks have used and overused time and again since the Great Recession. Just a week before the crisis, the Fed had set a limit on its bond buying. But now that limit is gone, and the current QE program is actually uncapped. It's completely open-ended. The Fed has also expanded the scope of what it can buy to include commercial mortgage-backed securities. Quantitative easing basically allows the Fed to print money and to flood the economy with it. Now, that sounds like a good plan in an emergency, but of course it has flaws, and we'll talk about some of those flaws coming up in the show. In truth, though, the Fed was already doing quantitative easing again before the pandemic. In fact, it started last fall in response to a liquidity crisis in the banking system linked to something called repurchase agreements, otherwise known as repos. Now, the Fed is pumping even more money into the repo market, which is an obscure but critically important part of the financial system. In addition to these moves, the Fed's lending money to 24 large financial institutions and some other smaller banks through 2 programs that they've revived from the financial crisis in 2008. It's also doing direct loans to banks from its discount window at a lower rate than it charged during the Great Recession. Now, while these moves are broader in scope than those used during the financial crisis, they're not really unprecedented. All of them are basically aimed at keeping the financial markets functioning. However, for this crisis, the Fed has gone even further with new programs and strategies, those aimed directly at helping businesses and workers. And we'll talk more about some of those new programs and the extent to which they might help later in the show. Now it's time to welcome my co-host, Jeff Small, president of Arbour Financial Services, a retirement income store located in Melbourne, Florida. He's also the brand ambassador for the Retirement Income Store and Amazon best-selling author of the book, Turning Financial Planning Right Side Up. So Jeff, what do you make, if you were sitting on the Fed, if you were part of the FOMC meeting, what would you be telling them to do differently right now?
Absolutely nothing. They're doing everything to perfection, Dave. Everything to reinflate asset prices, everything to create inflation at some point so interest rates can come back, providing plenty of buying potential of bad debt that might be out there if they need to do that, and plenty of stimulus as well. So absolutely nothing, Dave, is my answer. Well, how do you feel about that?
Well, I think they're getting a little bit crazy with some of the programs, frankly. I think they're, supporting bond prices in the secondary market. That doesn't really have any effect to me. That, it's great for the part of the program that's for new loans. Corporations need debt because they don't want to fail, they don't want to close down. It's an important corporation to our country. That helps the company stay alive, keep people employed, and do all the good things they do to keep our economy working. But the actual buying of the bonds, for example, is really doing nothing but just inflating the financial markets, and I believe giving people, really causing them to lose a sense of reality with where things should be valued, right?
Well, this is where you and I have a disagreement. And as a bond guy, you're super conservative and you think that the markets are going to go back and retrace the lows potentially, which anything is possible, I guess. The impossible can be possible. But with all of this stimulus on deck and everything they're doing, I think that the hands that they're playing are perfection. They could not be doing anything better. And they haven't bought any bonds yet other than U.S. Treasuries. They haven't bought munis. They haven't bought high yield stuff yet. They haven't bought corporates yet. They just have the markets are aware that they've got plans to do that if necessary. And so that might need to come to fruition, Dave, though, if companies start to fail as we unravel through this economic downturn that was mandated.
But you do agree that the stock market wouldn't be as high as it is today if it hadn't been for what the Fed did. You do agree that even corporate bond prices would still be a little lower, correct?
Well, that I agree completely with you on. I could not agree with you more on that fact.
How is it good then? Tell me how it's good that these investments aren't valued at their current level, that they're being overvalued artificially, and the average American doesn't have a clue because they don't understand this. Isn't transparency with real valuations better at the end of the day for the investors? I think so.
Well, I mean, financial engineering is not a transparent concept, Dave. The Fed has been financially engineering the economy, the markets, the rising of asset prices for a long time, since before the Great Depression this was started. So, they pulled out all the stops in the Great Depression in 29 and in the 30s, and they're pulling out all the stops now to make sure that capitalism and the ability to raise capital is preserved, and the economy has some velocity of money in the bank before it starts. And then when it finally catches fire, because we're going to have a very quick snapback now, when it finally catches fire, things are going to explode. And what consumers should be aware right now about is there's going to be inflation. That's what consumers should be concerned about, is inflation is coming and rates will rise because of that.
Well, my mama always told me that two wrongs don't make a right. And, just because they did it in 2008, I don't think it makes it any better today. It just makes it cumulative. It adds on to the overvaluations. And again, I agree with you. I think you're right. It's good to make sure that corporations who need to access money can get it so they can stay alive. I agree with that completely. But when you're doing things that aren't doing that are simply just propping up asset values to give people a false sense of confidence in their holdings, I just think that's a big mistake, because even professionals now don't know in many cases how to value things, because we're looking at them saying, well, what should this really be worth? How much was this holding affected by all the stimulus, and how much wasn't? So I'd like to see at least those values come back. As long as the financial system's moving and people can raise capital when needed to keep the economy going, that's great. But let's not create fake values. We have fake news. Let's not create fake values on people's investments, because I just think it gives them a false sense of confidence. It's almost like telling some people, hey, go ahead and jump out the window. You can fly, knowing that they can't really fly.
Right. I wouldn't say that the markets current valuation is based solely on the Fed. It's looking out 12, 13 months, the market's valuations on this potential recovery as a result of this mandated government shutdown.
Sure. Granted, 100%.
So, yeah.
So what's really going to be interesting...
It's not just what the Fed has done.
What's going to be really interesting is hearing what Harry Dent has to say about this. Because Harry Dent is usually bearish. I've got to imagine right now he's jumping up and down, stomping his feet, thinking, and he could hear what we're talking about, by the way. But I'd be interested to see what he would have to say about this, which we'll get to do in just a minute. Anything you do different? You know, we've got 45 seconds left. Anything you would do different? Any one small thing? There's got to be something you would do different if you were sitting on the FOMC, on the Fed board.
You know, I don't think there's anything that I would suggest to do different, Dave. With rates at zero, they essentially have free money, and they can add as much to their balance sheets as possible. The Fed has a lot more options in its war chest other than what they've shot so far. But getting back to Harry, I think and when Harry Dent comes on, we're going to find that this is his worst Willy Wonka financial nightmare because he hates debt.
Yeah.
He is going to explode.
Mm-hmm. I don't know. I've got to tell you, if I didn't know better, Jeff, I'd think that you're turning into a stock market cheerleader. You're going liberal on me. So I know you well enough. You're a close enough friend. I know that's not true. So we need to take a commercial break. You stay with us. Coming up, we're going to have Harry Dent, exclusive interview right here on the Income Generation. And you'll also get to find out whether or not my good friend Jeff Small is going liberal on us here in 2020. Stay with us. We'll be right back in a minute on the Income Generation. I'm David Scranton. As we reopen the economy, a renaissance has begun in the world of investing. If you or your advisor are not prepared for the new corona economy, you could be left behind. You don't have to cross your fingers and toes hoping for growth in this unpredictable stock market. There is a more conservative way, and that is to invest for income without all the stock market risk.
Call the Retirement Income Store today at 888-888-4176 for your free Retirement Income Kit. Call 888-888.
Investing for income? The idea has grown in popularity over the last several years due to today's volatile stock market. But if you're at or near retirement age, it's no longer just how much you've saved. It's about maximizing and protecting your life savings while minimizing your risk from market ups and downs. David J. Scranton's new book, The Retirement Income Story, is here to help baby boomers face the challenges of investing in this age of economic uncertainty. Visit theretirementincomestory.com to learn more.
If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. As mentioned, the extent of this coronavirus crisis is so broad that the Fed has widened its own scope in its response. Part of that broader response involved creating 2 new lending facilities to support highly rated U.S. companies. One allows the Fed to lend directly to corporations by buying new bonds and providing loans. The other allows it to purchase existing corporate bonds and exchange-traded funds, or ETFs, that actually invest in those corporate bonds. The overall goal of these programs is to allow companies access to credit in order to maintain their operations in the face of quarantines, forced closures, and other changes caused by the pandemic. As Dr. Ben Carson of the White House Coronavirus Task Force put it a few weeks ago, right here on the show, the government's trying to build a bridge to help maintain the country's economic infrastructure during the worst of the crisis. In addition to the Fed's efforts, that bridge also includes $3 trillion in congressional aid. But is it enough? Will the bridge hold? And more importantly, was the economy's infrastructure really all that sound to begin with? I'll talk more about that with our guest Harry Dent in just a bit. But first, let's quickly mention a few more efforts undertaken by the Fed to help businesses and workers. These include another lending facility, revived from the financial crisis, along with the new Main Street Lending Program, which is aimed primarily at helping mid-sized businesses. The Fed has also restarted its well-known TALF program, which supports lending to households, consumers, and small businesses, everything from student loans to credit cards. And finally, for the first time, the Fed has launched a program to lend directly to state and local governments. And that's a lot. But will it build a bridge strong enough to maintain our economic infrastructure through this crisis? So far, Wall Street at least seems to think so. But will it last? Right now, it's time to bring in co-host Jeff Small, along with our guest, Harry Dent. Harry's the author of the book 0 Hour. He's also the editor of the free newsletter, Economy and Markets, which you can review by going to harrydent.com. Harry, thanks for joining us today.
Yeah, nice to be here, David.
So I was with you, of course, back in February in Sun Valley, and you were saying that the market was overblown and you expected a pretty significant pullback, for the most part this year, if my memory serves me correctly. But did you think it was going to happen that soon? And did you think it was going to be because of the pandemic?
Well, we were looking for early March to May. We were in what I call the final kind of orgasmic phase of the bubble, which came when the Feds had to react to the repo crisis. They printed $760 billion in just a couple of months. So that was, and the markets were going straight up that. I figured that would end as early March. Well, then the virus comes in and heads that off a few weeks early. But I said, hey, it doesn't matter what the trigger, and this is a hell of a trigger, but the first crash in a bubble like this is usually about 40% in less than a couple of months, and that's what we got, even quicker. This was in 5 weeks, the fastest crash in U.S. history outside of 1987, which was kind of a wild thing. So this, I did not expect this to trigger it. I was expecting defaults in China, big developers, or in the frackers, in the U.S. with low oil prices. It takes a lot of things like the subprime crisis last time, but it doesn't matter. I tell David, don't confuse this virus, which is the perfect trigger and a deep shock, a sudden shock, with the fact that we have the most over-leveraged, over-indebted, overstimulated economy in history since 2009. And when this thing goes, this is just the first crash. We're in what I call the predictable rebound for 4, 5, 6 months, and likely towards the election. And then we will not come out of this shock. Everybody thinks, once the virus disappears. No. Too many businesses will fail and never come back. And I learned that from Harry, the hurricane in Puerto Rico.
Harry, granted, hurricane in Puerto Rico was horrible. A humanitarian crisis like what we're going through now, just different. But are you surprised the extent to which the markets rebounded short term after the bottom in March?
Exactly what happens. Most of the rebound happens in 4 weeks, and then it goes sideways, edging up for several months. This is following the formula perfectly for the 1929 crash, first crash and rebound for 5 months after that. The 2000, the last big bubble we had, the 2000 tech crash, we had a 40-some% crash and then a rebound like this for 3 or 4 months. This is just a little stronger because we have so much stimulus. The amount of stimulus they came up with in weeks was astounding, which shows how desperate they are to keep this darn thing going. So that's a danger sign to me.
It's incredible, and I know that you're expecting perhaps even a bigger wave down. So I want to hand it over to my co-host Jeff Small, because he exposed himself last week on the show that he's a little more bullish than maybe you and I are. So Jeff.
Hey, Harry, it's Jeff Small here. Hey, sometimes the triumph of optimists leads to success or even foolishness and stupidity. And right now the market is snapping back, so the optimists are winning. But what we anticipate coming forward, and I'm really curious to get your insight on this because you're a market historian, what we see will happen to the markets even worse if we have a second wave as compared to the Spanish flu. The Dow did not start to trend down even for a long-term protracted time until we had the second wave. And so I'm curious to gain your insight on that.
Well, first of all, the Spanish flu was so much worse. 50 million people died. There was a thing in the summer, a little one, nobody paid attention. Then it came back when World War I ended. It came back massively because everybody partied. and got out in the streets and stuff. So it was terrible. 50 million people. But let me give you the comparison. The Dow Jones went down 11% at worst. This is such a reaction because the bubble is so great. And I've been saying this, it could be any trigger to cause this. So this is going to crash, from my view, Jeff, just like any major bubble in history. First big crash, rebound for all types of reasons. Oh, the government, plenty of stimulus, things are coming back. The virus isn't going to last. The virus will probably come back, but not, I don't think, terribly bad, because people are on guard this time and they're not going to go out and party like they did after World War I. So I see that as a minor threat. We are so much in debt, Jeff. The demographics have been getting worse since 2008. I predicted the 2008 crash 20 years before it happened, just as baby boomers would stop spending and everything would be overvalued. Well, things are way more overvalued. We have 80 trillion more debt in the world today than we had back then. And demographics are getting even weaker into 2023 before they turn around. So I say we get a big whack here, and then a lot of businesses go under, and a lot of baby boomers right now, you know what they're doing? They're getting on the dole, and then they're going to retire. They're never going to come back. Today, they've intended. And so we don't see the economy go back to normal like people think. It's going to be U-shaped at best after a couple of months shock. And we just don't come out of this, and then the debt and the overvaluation of financial assets keeps weighing in, and we go into a deeper crash and deleveraging.
So just so I understand, Harry, what you're saying then is we can't expect the economy to grow if we're growing the debt quicker than the actual economy.
Right.
And what you're anticipating then is even though the markets had a V-shaped recovery, a truncated V, because we've kind of hit the top here and we're not at the peak, we're going to have more of a W recovery in the market, where we have a peak, a valley, a peak, another valley, and then hopefully come back to another peak.
And Harry,
is that what you...
And Harry, we need to take a commercial break, so we need to invite you back. Hope you'll stay with us for a few more minutes to answer that question. I've always got one too stewing in my mind. So stay with us, please. And you stay with us too. We have a lot more to come from Harry Dent in just a moment. We'll be right back. Hi, I'm David Scranton. As we reopen America during these difficult times, we're all practicing social distancing. But at the Retirement Income Store, we're also practicing stock market distancing. You don't have to cross your fingers and toes hoping for growth in this unpredictable stock market. There is a more conservative way, and that is to invest for income without all the stock market risk.
Call the Retirement Income Store today at 888-888-4176 for your free retirement income kit. Call 888-888-40.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
I continue to think, and my colleagues on the Federal Open Market Committee continue to think, that negative interest rates is probably not an appropriate or useful policy for us here in the United States.
And why not? The president seems to think it would help.
The evidence on whether it helps is quite mixed.
Fed Chairman Jerome Powell says he doesn't foresee lowering U.S. interest rates below zero in response to the crisis. Even though other central banks have moved to negative interest rates, and some, including President Trump, have argued that it would help here in the United States. Now, although the concept is odd, in theory, negative interest rates are a way to help spur more business and more commerce. However, Powell says negative rates also cause, quote, distortions in the financial system, close quote. Distortions that he feels would outweigh their potential benefits. And to me, that's a little ironic when you consider that quantitative easing also causes distortions in the financial system, which we've talked about frequently right here on the show. Yet the Fed has no problem using QE over and over again, since the financial crisis, and to an extent that I personally believe is reckless. Like negative interest rates, quantitative easing sounds great on paper. As I explained, it basically allows the Fed to print money and flood the economy with it. All the textbooks say that that's how you stimulate growth. But what the textbooks fail to consider is this. What if nobody spends that money? What if they just hold on to it or use it to pay down debt or put it in investments, which they're probably more apt to do in times of great uncertainty like today? Well, what happens is that QE ends up having a very limited effect on the actual economy, but an enormous effect on the stock market. The market has basically been addicted to QE for a decade now, and that largely explains the huge disparity between stock market growth and GDP growth over all of that time. It's as if Wall Street has been anticipating 5% growth year after year after year, and every time it doesn't happen, the Fed floods the system with more cheap money to buy us more time. By that, I mean time before the overvalued stock market is forced to make fundamental sense once again with a major correction. Can open-ended QE and all the Fed's other efforts continue to prevent it from happening, even in the face of the country's greatest economic challenge since the Great Depression? Well, Chairman Powell is trying to make that case, telling 60 Minutes there's a lot more we can do in response to this crisis. I have no doubt the Fed will do more, and it wouldn't even surprise me to see them change their minds about negative interest rates. But will it be enough? And what might it mean for your personal finances if the answer is no? Now it's time to bring back co-host Jeff Small, along with our special guest author Harry Dent, editor of the free newsletter Economy and Markets, which you can review by going to harrydent.com. Harry, thanks for being kind enough to stick around.
Sure.
So, okay, right before the break, Jeff had asked a question. And he had said, gosh, you know, you're talking U-shape. It sounds like you almost think there's going to be a W-shaped recovery. And I would actually say it could be a W with maybe a few more W's connected to it. Your thoughts?
Well, you know, I see more like, I hate to say it, a truncated V, that the stock market isn't a V-shaped rally, which is absurd because we're not going to get a V-shaped recovery in the economy. It's not even possible in any of my scenarios. But the economy goes down, it starts to come back, but comes back weaker than people think. And then the stock market starts to fall, and then debt problems start to, emerge around the world. Again, people do not know how weak this economy is. How come it's taken 16 trillion in money printing around the world, and now another 5 trillion just recently? All these stimulus plans, and the best we can grow is 2% in the US, 1.5% in Europe, and 1% in Japan. We are already weak, and all it takes is this shock to prove it. I am telling you, a lot of businesses will never come back out of this. We saw it happen in the hurricane in Puerto Rico, a similar 3-month short-term shock, and then businesses don't come back, and you never come out of it. And we have a deeper downturn from late 2020, early 2021, all the way into late 2022. By the way, I've been forecasting for 20-some years that the bottom of the biggest crisis of our lifetime would be in late 2022. So this is much bigger than anybody's seeing. It's on a 90-year cycle to 1929 to 32, 1837 to 42. Mega bubbles, mega depressions and resets, deleveraging of debt and financial asset bubbles. The difference this time, you guys, the financial asset bubbles are much bigger because they blew up the financial bubbles to get out of the debt crisis in 2008. And now they've got a bigger financial.
Now, Harry, during the Great Depression, of course, the stock market went down 90%. If you were a betting man and you had a guess, how far down will the bottom of the market be this time?
My forecast for years has been 5,000, give or take 3,800 to 6,600, 5,000 on the Dow. That's about 85%. And of course, on the NASDAQ or the Russell 2000, it could be that 89% we saw in 1929. It is of that level. Real estate went down 34% last time. I'd say 45 to 50% this time. And you saw how much havoc that caused on the bank. Sure. The real estate bubble has come back for a second time. And this is more global. And whatever we have here will make China look good, because China has got the biggest bubble in the world, particularly in real estate.
So Jeff, is Harry helping curb your optimism about the stock market future just a little bit here today?
Well, I know Harry's calling the Dow is between 5,000 and 6,800, but I mean, Harry, come on, you got to work with me here. Anybody can pick a number out. there's got to be a reason for they're the sellers or the holders of investments in the market, the holders of stocks, to sell to get to that point.
Yeah,
and
it's called fear, Jeff. It's called when reality hits. We've been living off of trillions and trillions of money printing out of thin air for 11 years. Anybody thinks you get something for nothing in this world, be happy and expect things to get better. I'm telling you, this economy is so weak. When it starts to fall, people are going to run. That's what
I agree with you. I agree with you there.
90 years. So I'm not pulling a number out of my, you know what.
I agree with you, Harry. I agree with you, but 5,000 to 6,800 is a little bit of a stretch. We'd have to have a humongous reason for people to sell off
everything. There will be a humongous reason, and if it's not, I'm going to quit my profession in 2022 and be a limo driver in the Gold Coast of Australia.
Well, what would the reasons be, Harry? Tell us what you think the reasons are that would push prices down that low.
What happened in 1929 to 32? Massive failures. What happened in 2008 and 9? It wasn't just financial institutions and Lehman Brothers, which they sacrificed. It was GM. It was AIG. Major company. We were going into a depression, and the only way we got out of it was they printed trillions and trillions of dollars to cover it over. They didn't deleverage debt. They didn't let the economy get rid of its excesses. So we're going to have to do it now bigger. We have more debt and weaker demographics than we had back then. We're just going to come down to reality. That's all it is, Jeff. We are so far out of reality. It's not funny. And nobody realizes that because we're living in bubble la-la land, and even Warren Buffett doesn't get it.
You know, I have to tell you, Harry, I love your passion. But I got to ask you on the personal side, how's your blood pressure?
I don't have high blood pressure.
Guys, see, that's how it is. People who let it all out like that.
I've never had high blood pressure. I don't understand. If anybody should have it, I should have it.
I know exactly. That's my whole point, but that's awesome. So final question then for our viewers, for our listeners, and we've got only 1 minute left. So what do you think? Those are more conservative, should obviously just stay out of the market, but those are more aggressive. Are there opportunities for more aggressive investors to game this, or is it too dangerous?
Oh, no, absolutely. There's no better time to make money than a big crash. If you just and look what happened in this first crash. It was already instructive. What did the best? The treasury bonds, the 10 to 30-year treasury bonds went up 24%, while stocks went down 32 to 44 in different indices U.S. So that's what you do. You get in the safest, high-quality bonds. They like deflation. They don't have the default risk that corporate bonds do and junk bonds. And then, of course, as things go down, you buy stuff that goes down. Commodities are already down 70-some% at worst. Yeah. And they're just going to end up down 80. So you get huge buying opportunities once in a lifetime on the other end of this, and you can actually make money through some simple inverse funds with no leverage, and by being in the highest quality AAA corporate and 10 and 30-year treasury bonds. You make money in a downturn.
And Harry, I'll just add on that disclaimer that only for those who are willing to take that kind of risk and are part of the income generation, have already met their income needs from investments. Then you could be a capitalist and take advantage of these opportunities.
Well, these treasury bonds are considered
unfortunately, we need to leave it there for now, Harry. We're out of time. We have to go to commercial. Thanks so much for being back with us. We really appreciate it. And you stay with us too. We'll be back here with more coming up in a moment, right here on the Income Generation. We'll be right back.
I keep my eyes wide open all the time. I keep the ends out for the tie that binds. Because you're mine, I walk the line.
Johnny Cash isn't the only one who walks the line. In the course of his recent interview with 60 Minutes, Fed Chairman Jerome Powell walked a fine line between optimism and frankness while discussing the coronavirus crisis and our nation's prospects for recovery. Every Fed chair has had to really walk this same tricky line. However, it's become even trickier in the age of quantitative easing because the stock market has become so strongly influenced by the Fed's actions and, yes, its words. The 60 Minutes interview offered a perfect example of this. During the interview, Chairman Powell said that while he would never bet against the American economy, he admitted that the recovery may stretch into next year and that a full rebound may not occur until we have a vaccine. Within minutes, interviewer Scott Pelley informed Powell that he just received a notification on his phone that read, quote, Dow tanks more than 500 points in Wall Street sell-off after Fed chair warns economic recovery will be prolonged and bumpy. Now, Jeff, I'm sure it wasn't a surprise to analysts when hearing, Chairman Powell say it's going to be a bumpy recovery. People have been talking about that for a long time. Heck, we just, talked to Harry Dent who told us that. But isn't it amazing that one man's words can affect the market by 500 points in literally just a few minutes?
Well, it is amazing, but that's not surprising, Dave, because whenever the Fed chair speaks, the market listens intently for any kind of post-game reaction to how the market is going to, react to his comments.
Yeah. Well, okay, so now that we had Harry Dent kind of act as a tiebreaker, if you will, between us, it was only a week or two ago that we needed a guest as a tiebreaker, I think Peter Morisi, and he broke the tie in your favor. But this time, Harry Dent broke the tie in my favor. But so I guess you and I are tied now, right? But bottom line is this, though. Would we still have seen a 500-point drop on those words, which weren't a surprise to anyone, if the market was accurately valued versus overvalued by all the artificial Fed stimulus?
No, I don't think anybody should be surprised by the fact that when the Fed says we're going to have a long and difficult recovery, it's not going to be easy economic hurdles to climb, that the market is going to react to that when the Fed chair speaks, when Jerome Powell speaks. That's pretty normal, but the market reversed very quickly, Dave, to invalidate your perspectives here. Not to do that intentionally, but it reversed historically, just reversed. And so I think it'll react in a knee-jerk reaction in some form or fashion on some of these issues, but on other ones it will not react like this. And so that's why we have a market.
So did Harry Dent budge you just a little bit? Did Harry Dent just pull you a little bit over in my direction? Come on, tell the truth now, Jeff.
Well, I mean, if I can speak freely, with Harry, I thought that he came a little unglued, just a little bit. I think his forecast of the Dow hitting 5,000 to 6,800 is completely off the reservation, so to speak. I don't think that's possible unless we had a massive, surge. It was 10 times, 20 times worse than we have in the coronavirus now. That would completely stop global productivity. So he's in your camp, let's just say.
Okay, all right. So we haven't swayed you at all. You're sitting in a stalwart fashion right where you are, thinking the Fed did a perfect job. And don't get me wrong, I think the Fed did a pretty good job with this. They reacted quickly, so they've got to be given credit in many ways. My concern is I think they, in some ways, overreacted, including Congress, right? I mean, think about this. There are people, from a congressional standpoint, there are people now who are getting paid more to stay home than to go to work. And surely you haven't gone so far over to the liberal side that you think that's a good idea, right, Jeff?
Well, no, that's a terrible idea, Dave. But, continuing jobless claims fell 3.86 million this week, which is a huge sign that the recovery is going to come back and people are going to get rehired. People want to come back and work, but there are those that would prefer to stay home and collect unemployment, and that shouldn't be allowed. On the Congress's side of the equation, though, that's way different than the Fed, Dave. Way different.
Yeah, that is much different. We can take a quick commercial break, Jeff. We'll be back in a minute here. We have more to come right here on the Income Generation in just a moment. We'll be right back.
Visit theRetirementIncomeStore.com today to find out how you can rescue your retirement.
Welcome back to The Income Generation. I'm Dave Scranton, and I'm here with my good friend and co-host, Jeff Small. So Jeff, let's put it in perspective now for our Income Generation viewers or Income Generation listeners, because I don't want them to walk away thinking that if they're part of the Income Generation, that you think everything's great with the market and they should be more aggressive and focus on growth strategies. I know you well enough to know that's not true, especially when so many companies over the last couple months have cut dividends or even eliminated their dividends. So I think we need to take a minute and talk to our viewers about the real world side of this. If you're part of the Income Generation, that is, you're retired or within 10 years of retirement.
Sure. Well, if you're in the income generation age range, Dave, which, for our listeners and our viewers, I think it's really important to have a perspective on the markets. Dave's points are all incredibly valid. I've got some merit to mine, but from your perspective as a viewer and a listener, you want to be really concerned about losing money at this stage because things can go wrong in the market. You don't want to have money exposed to risk unless it's money that you can live without, that does not need to create income for you to have a good retirement income while you're retired.
Yeah, that's the key part, the income, because if you're living on a stock portfolio and your dividends just got cut in half, all of a sudden you're making some radical changes in retirement. And, at the end of the day, I don't think any of our viewers or listeners retired to become unretired afterward. You retire to stay retired and to do all the things you've always wanted to do, that you've dreamt of. So I think those are two great points. Number one, the concept of lowering your risk when you get to that point, but also the other thing is that it's great if that dividend from a common stock is gravy or from a stock mutual fund is gravy, but if something that you really need to live on, then you shouldn't be using stocks for that. You should be getting your income from other sources.
Could not agree with you more, Dave, and I think that's where people get really in big trouble. When we look at what happened in 2008, we look at what happened in 2003, people had to stop taking income from their portfolios because they had too much risk at those market peaks, and we're approaching those peaks again. Yeah. And so you got to be really careful if you're retired.
Well, I know you and I have developed a calculator which actually shows people, if they were invested in the stock market back, let's say 20 years ago in the year 2000 with all of its gyrations. And if, let's say, you had $1 million, you only needed $40,000 a year, right? 4% per year for income, that's it. But you took it out of the stock portfolio. Our calculator shows that maybe 20 years later, you'd only have $350,000 left. You'd have 35% of what you started with.
Those numbers are dismal, and that's why you can't use the market as a tool for creating income. It's a tool for accumulation, not creating income, Dave.
We need to take a commercial break. We're going to come back and wrap up the show and give you more words of wisdom coming up here in a moment, right here on the Income Generation. So stay with us. We're going to be right back. I'd like to thank our guest, Harry Dent, and of course my good friend and co-host, Jeff Small, for joining me today on The Income Generation. But I also want to thank you, our new and returning viewers. Let's say you're on vacation somewhere, and you're walking across a footbridge over a deep gorge, like the Grand Canyon. The bridge seems sturdy, but halfway across, a big wind comes up and the bridge starts swaying and buckling. You make your way back to safety, and the wind dies down, but continues blowing. In fact, the bridge is still swaying a bit, but your guide is assuring you everything's fine now and you could start right back across the bridge again. Would you do it? Or would you more likely wait until the wind died down completely and you felt more certain the bridge was safe? In a way, that's how you can think about the stock market right now. We saw it sway and buckle dangerously back in March when this coronavirus crisis first hit, and the market fell by nearly 40%. The winds have calmed since then, and the market has rebounded by almost 3/4. But does that mean the danger is gone? Well, personally and professionally, I don't think so. Despite unprecedented levels of relief and stimulus by Congress and the Federal Reserve, I believe the danger still remains. In fact, I believe the danger is greater than ever, ironically, thanks to the overuse of economic stimulus by the Fed since this financial crisis. It's created a stock market dangerously addicted to cheap money and low interest rates and largely detached from economic realities. However, in the face of our current crisis, I don't believe it's going to be able to remain detached forever. The good news is that there is still time to get to safer investments. Still time to decrease your stock market risk by switching your financial focus from portfolio growth to portfolio retirement income. Doing so means you'll not only be better protected from the market turmoil still likely to come, but you'll also be in a better position to take advantage of opportunities as they emerge in this new corona economy. And it all starts with one phone call. As always, stay safe and thanks for watching. If you're close to retirement and you really want to know how to protect and maximize your money, it's essential you stay informed and up to date. And as you know, right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. We'll see you all next Sunday.